Inflation is a rise in prices, which can be translated as the decline of purchasing power over time. It means that a unit of money buys fewer goods and services than it did in the past. Inflation is usually measured by the average price increase of a basket of selected goods and services over some period of time. There are different types of inflation, such as demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation occurs when the demand for goods and services exceeds the supply, causing prices to rise. Cost push inflation occurs when the cost of production increases, such as wages, raw materials, or taxes, and is passed on to consumers. Built-in inflation occurs when people expect prices to rise and adjust their behavior accordingly, such as demanding higher wages or raising prices. Inflation affects your purchasing power and savings in various ways. Purchasing power is the amount of goods and services that you can buy with a given amount of money. When prices rise, your purchasing power decreases, meaning that you can buy less with the same amount of money. For example, if a loaf of bread costs $1 today and $1.10 tomorrow, your purchasing power has decreased by 10 cents. Savings are the amount of money that you have left after spending on your needs and wants. When prices rise, your savings lose value over time, meaning that you can buy less with the same amount of money in the future. For example, if you save $100 today and prices increase by 10% in a year, your $100 will only be worth $90 in terms of purchasing power next year. Inflation can have positive or negative effects on the economy and society, depending on the rate and causes of inflation. Some positive effects include stimulating economic growth, reducing unemployment, encouraging investment and innovation, and reducing debt burdens. Some negative effects include eroding living standards, creating uncertainty and instability, discouraging saving and lending, and redistributing income and wealth. One of the biggest challenges that we face as investors is how to protect our money from inflation. Inflation is the general increase in the prices of goods and services over time, which reduces the purchasing power of our money. In other words, inflation makes things more expensive and makes our money worth less. Inflation can be caused by many factors, such as supply and demand imbalances, government spending, monetary policy, currency fluctuations, and global events. The most common measure of inflation is the Consumer Price Index, CPI, which tracks the changes in the prices of a basket of goods and services that represent the average consumer spending habits. The CPI has been rising steadily in the past year, reaching 6% in February 2023, the highest level since. This means that the cost of living has increased by 6% in the past 12 months, which can have a significant impact on your savings and investments. So how can you hedge against inflation and preserve the value of your money? Here are some tips and tricks that can help you invest wisely and diversify your income sources to cope with rising prices. Tip number 1. Move your money into a high-yield savings account. If you have your money stashed in a checking or basic savings account, or worse, at home, inflation erodes the value over time. You can reduce your losses by moving the money you can't risk investing, like your emergency fund or house down payment savings, to a high-yield savings account. A high-yield savings account is a type of bank account that pays a higher interest rate than a regular savings account. The interest rate is usually based on the market conditions and can vary from bank to bank. According to Forbes Advisor, the average savings account APY was 0.37% as of March 20th, based on the latest data available. But with a high-yield savings account, APYs are as high as 4.29%. While a high-yield savings account won't match the inflation rate, it will help you earn some interest on your money and keep up with inflation better than other bank accounts. You can check out Forbes Advisor's picks for the best high-yield savings accounts to find an account that suits your needs. Tip number 2. Buy Treasury bonds. Treasury bonds are debt securities issued by the U.S. government that pay a fixed interest rate every 6 months until maturity. They are considered to be one of the safest investments in the world because they are backed by the full faith and credit of the U.S. government. There are two popular types of treasury bonds that are good investments for individuals who are worried about inflation. Series I savings bonds and treasury inflation-protected securities, TIPS. Series I bonds are interest-bearing government savings bonds that earn interest and are protected against inflation. They have an annual interest rate based on a fixed rate and a semi-annual variable rate based on inflation. Series I bonds issued between May and October 2022 have a rate of 9.62%, according to treasurydirect.gov. TIPS are designed to help investors protect themselves against inflation, as they are indexed to inflation. As inflation rates rise, TIPS adjust in price to maintain their value. The interest rate on TIPS is fixed, but the principal amount changes with the CPI. For example, if you buy a $1,000 TIPS with a 2% interest rate and inflation rises by 3%, your principal will increase to $1,030 and you will receive $20.60 in interest. You can buy both types of treasury bond at treasurydirect.gov or through a broker or financial institution. Tip number 3. Invest in the stock market. The stock market is another way to hedge against inflation, as stocks tend to perform well when prices rise. This is because companies can pass on higher costs to their customers by raising their prices, which can boost their revenues and profits. Also, stocks represent ownership in real assets that can appreciate in value over time. However, not all stocks are equally resistant to inflation. Some sectors may benefit more from inflation than others, depending on their pricing power, cost structure, and competitive advantage. For example, commodity producers like energy and mining companies may benefit from higher prices for their products, while consumer staples like food and beverage companies may have more pricing power than discretionary goods like clothing and electronics. One way to invest in the stock market is to buy diversified index funds based on broad market indexes like the S&P 500 or Nasdaq. These funds track the performance of hundreds or thousands of companies across different industries and sectors, which can reduce your risk and exposure to any single company or sector. Another way to invest in the stock market is to buy sector-specific ETFs or mutual funds that focus on industries that are more resilient to inflation, such as commodities, real estate investment trusts, REITs, utilities, or healthcare. Tip number 4. Diversify your portfolio. Diversification is important when investing in inflation hedges. Most well-diversified portfolios have an allocation to a range of hedges across various different asset classes. Mix in at least 3 or 4 different hedges to ensure you're covered if prices start to rise and one doesn't perform as well as you thought. For example, you could allocate some of your portfolio to stocks, some to treasury bonds, some to commodities and some to alternative investments like cryptocurrencies or art. The exact allocation will depend on your risk tolerance, time horizon, and investment goals. Diversifying your portfolio can help you reduce your volatility and improve your returns over time by spreading your risk across different assets that have different correlations with each other. Correlation measures how closely two assets move together in price. A positive correlation means they move in the same direction, while a negative correlation means they move in opposite directions. Ideally, you want to invest in assets that have low or negative correlations with each other so that when one asset goes down, another one goes up or stays stable. This way, you can balance out your losses and gains and smooth out your portfolio performance. Tip number 5. Explore alternative investments. Alternative investments are any investments that fall outside of the traditional asset classes like stocks, bonds, and cash. They include things like cryptocurrencies, art, collectibles, private equity, hedge funds, and venture capital. Alternative investments can offer several benefits for investors who want to hedge against inflation. First, they can provide higher returns than traditional investments because they are often less efficient and more risky than mainstream markets. Second, they can offer diversification benefits because they have low or negative correlations with traditional investments. Third, they can offer exposure to new sources of growth and innovation that may not be available in traditional markets. However, alternative investments also come with some drawbacks that investors should be aware of before investing. First, they can be more volatile and illiquid than traditional investments because they are subject to more uncertainty and less regulation than mainstream markets. Second, they can be more expensive and complex than traditional investments because they often require higher fees, taxes, and due diligence than mainstream markets. Third, they can be more difficult to access and evaluate than traditional investments because they often require special platforms, networks, or expertise than mainstream markets. Therefore, alternative investments are not suitable for everyone and should only be considered by sophisticated investors who have enough knowledge, experience, and capital to handle their risks and costs.